This is Cece. Welcome to the Orbit. It is Thursday, February 1st. We've got the markets attempting a little bounce here from yesterday's sell-off, the FOMC day, kind of ugly into the close. Seems to have held for now that 48.50 level. We're looking at SPX, bounce back up to about 48.71. You can see on the chart where we kind of tanked after that FOMC into the close. Not quite back up to those levels. Those were closer to 48.80 before we were sent lower. There was some wild, let's just zoom in on this, some wild movement after the FOMC, which is not uncommon. We went up above 4,900, touched about 49.05, immediately sold off down to 48.50, and then kind of closed near there, right under there, and now it's attempting a bounce. The expected move for today is about 0.4%. Still a little bit inflated. See that 21 vol. The day after an FOMC announcement, especially where you had some volatility the day before, it's not uncommon to see volatility kind of hold that day after because you either see everybody shake off the FOMC move from the day before and say, what were we thinking? Or it's a follow through and people are like, oh man, that sell-off was real, or that rally was real. In this case, it's sort of, so far, the market's shaking off that late day selling. And of course, that is some disappointment that they're not going to lower rates in March, like a lot of people, or some people thought. And I think it was Goldman Sachs is now pushing that estimate of lowering rates out to May. Not a massive surprise for a lot of people in the market, and that might be why you see, sort of people waking up and saying that's not that big of a deal. Were they really ever going to lower rates in March? So for now, we've got a 0.4% expected move. The rest of the day, you can sort of see those levels. Right now, it's interesting because that lower level is at that 48.50 level. You can see to the bottom. So let's just look here at like a credit put spread for today down at those levels. So this is selling the 48.50. Now, well, let's look at the other side of this and let's see where that expected move on the day. So let's go to credit call spread. So right now we're at about that 48.90 level. And again, risking forward to make one, take the whole thing down. So you can sit here and play around with it, and it's like, all right, well, there's the expected move. Here are these different levels. Where is my actual risk? Potentially it's that the market reverses, or if it rips higher, is it probably not going to get up above this level? So that's just sort of the type of 2-day chart thinking, or 1-week chart type thinking. I'm taking it out to the week. You could see these highs. Of course, today is big earnings reports after the bell. Let's go to those real quick. So we have Meta, we have Apple, and we have Amazon, right? So let's go to Amazon real quick. And what we've got here is about a 6.2% expected move. That seems kind of large. Let's check on historical earnings. That is, in fact, not that high. We had a 7% move higher last time, an 8% move higher the time before that, a down 4%, and a down 8%. So it's a little bit less than 3 of the last 4. It's a little bit more than 1 of the last 4. That is a 6.2% expected move at 143 vol. I can already tell from the chart, and this is one of the things we talk about here on the Orbit, this is really pumped vol, obviously, 1 day to expiration in earnings, 143 vol. This flat line of this expected move is a telltale sign that you're going to see a very steep decline in IV out a couple of months. And so we're at the 3-month thing. We got 143 here, and we've got 31 vol out here in April, right? So as a trader, if I'm looking at this, I'm saying, all right, let's say I'm bullish Amazon and I want to play for a move to the upside. I could either be buying 143 vol here for a 6.2% expected move, or you could be coming out here paying for vol in the 30s and like an 8.5% expected move in March, 8.9. So that's a 9% expected move in March, and it's a 10.5% expected move in April, whereas options are pricing a 6% expected move just for tomorrow. So that kind of gives you a good indication of, if you're playing directionally. If you're if you're looking for if you're bearish, or if you're looking for a hedge and you're looking down, say these levels are like, you do not probably want to be buying premium for this earnings event. You may get your move, but you're going to get your move also if you're along a put spread out here or along a call spread out here. So coming down to these levels, saying you want to protect to 140 in the stock, you can come out here and catch that out in March and April. There you have a 10.5% expected move down to 141. Let's look at the put spread there. And there we have it, an April put spread. It's 20 wide. It's buying the 160, selling the 140, taking you down to these levels that we just identified on the chart. The break even on this put spread is 153. That's just $4.50 lower in the stock, and out till April. And you can see on the chart where it catches these levels in the past. So that's just something to be cognizant of, is with earnings, the vol's pumped. You want to be a seller of high vol. You want to be a buyer of low vol. If you're playing for moves on these earnings events, if you're selling near-term vol, selling the move, that's really, you're looking at levels. What are the risks here? The breakout, there's really sort of nothing to look at in the past. To the downside, you're looking at some of these levels and you're saying, is it worth the risk to be, short this strike, or do I need to go down a little bit lower, down to here, to be safe or safer? Apple, we've got a 3.5% expected move. That's obviously much less than Amazon. We saw it move last time. We saw it down 5%, up 5%, and up about 2.5%. So it's trying to be right in there. Yeah, it's a small expected move. And the way this works with earnings is, the smaller the expected move, the smaller the volatility, the less likely it is to make a massive move higher, because it just doesn't have that short gamma backdrop that high vol stocks have. However, for Apple to move more than 3.5% is going to happen more often than if volatility was a lot higher and it was a 5.5% expected move. So basically in the last month and a half, we've seen 200, we've seen 180. So it's been about in a $20 range, and the expected move is about a $6 range. So that's something to be looking at in recent history. Where have the highs and lows been? For instance, Apple has gone from 195 to 185 in the last week, really. And so for earnings to only be pricing a less than that is, something to be aware of. If there is a beat or a miss and the market gets going, it's not going to take much for it to be more than that 3.5% expected move. Finally, Meta, we've got about a 6% expected move. You can see the chart when we back it up here. Again, it's another situation where we've got front month vol 140, and coming out here to April, we're about 33. So 4 times the vol, and it's 6% here for the expected move, and going out to March, it's about 10%. So again, very similar expected move chart.